All right. Today is Sunday, December 26th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. I hope that everybody had a great holiday. Between you and I, for me, not so good. I bought my wife one of those gift card holders, and the card says ho, ho, ho. And I told my wife I looked for the one that says wife, but they ran out. There was a shortage. So I thought ho's close enough. And now I'm divorced and homeless. But anyhow, I'm not the only one who had a bad Christmas, by the way. A lot of you who are traveling this weekend, or shall we say, planned to travel, well, you had a bad one too, because we had, according to the latest numbers I read, over 1,500 flights canceled over the weekend. And I warned you about all of this ahead of time, but you said, hey bro, what do you know? Flying is safe and enjoyable, and the industry is going back on its feet, no problems whatsoever, really? Who wants to fly these days? With all the restrictions, the seat belts, the masks, you think they were transporting Hannibal Lecter. And on top of that, they want to ban alcohol too. No thanks. And on top of that, remember when the government came out a few months ago and they said, this winter season will be drier than expected. It will be warmer and drier than expectations in the Southwest, including California. Prepare for the drought to prolong. That was the forecast, right? I told you back then this is all bullshit to drop natural gas prices down. When the government says it's going to be dry, prepare to be more moist than, okay, I'm not going to make that joke, but we're having more rain than ever. And it's even snowing in California. And if that wasn't enough, we're seeing cruises docked, nobody getting out, and the reason is we have cases skyrocketing in these ships. And now these folks have to quarantine in these ships. They spent their Christmas alone in a ship. So if you thought you had it bad, think again. And of course, rest in peace to those who bought the dip in airlines and cruises. What a genius move, right? Now you're going to see the tsunami of cancellation when people realize that if you get a case while you're on a cruise, you're gonna be locked up for days inside that cruise. So rest in peace and good luck. But here's what I want to talk about today. The wall of worry, because the band-aids are being ripped off from pretty much every single item in the wall of worry, be it Russia, be it the Build Back Better deal in the brothel in DC, no more stimmies, that's gone. The fiscal support, poof, gone. The situation with Russia is heating up. And it's getting crazy. Cases are rising with the Pokemon variant. And of course, we have the Hawk, who has to do something here. And the market is being hit from every single angle when it comes to the wall of worry. But perhaps the main concern and the topic of this video is China. And here it is, folks. In focus tonight, something really strange is happening in China. And nobody's talking about it right now. Nobody's noticing. Everybody's brushing it off. But this is perhaps the next shoe that's gonna drop here. Now, I want to give you a background about what's going on in the Chinese economy, and then we'll talk about the big bomb, the strange occurrence that is happening right now in the Chinese economy. You might be aware that this year was a horrific year for Chinese investing and Chinese stocks in general. And I warned you in this channel this time last year, do not buy the dip in Alibaba. Do not buy any Chinese stocks. And if you listen to this advice, you have avoided the disaster that took place in Chinese stocks. Chinese stocks lost $600 billion from the US market alone in 2021, and the pain is just starting. On top of that, we have a tug of war between US and Chinese regulators. So if you are a retail investor buying these Chinese stocks, investing in these Chinese stocks, prepare for a lot of pain. Yes, I know there is a lot of fear, and perhaps we should do some bottom fishing here, but the uncertainty is just too high for my taste. We need some certainty, some assurances, some clearance before we start buying the dip in these Chinese stocks. Yes, the valuations are attractive, but they could be getting attractive for a reason, and it's not a good one. You see, on top of the disaster in Chinese stocks, we also have a ongoing disaster right now as we speak in the Chinese housing market. This is the third consecutive month where Chinese home prices went down. This is the first time this has happened in many years. And of course, this ties up with the Evergrande disaster. And before you start bottom fishing in Evergrande or any of the junk bonds in the Chinese market, here's a piece of advice from somebody who makes their bread and butter from buying junk bonds. Manager who gained 85% on distressed debt says beware Evergrande. Zhang Zhiyun. And forgive me for the mispronunciation here. Taking Mandarin courses is on my New Year's resolution list. But until then, we're gonna mispronounce a lot of things. Anyhow, he's the chairman of private fund manager Beijing Dingnu Investment Management Company. And he said his firm has not bought Evergrande bonds since May after its previous holding matured. Two of his company's credit-focused funds have beaten 99% of peers this year, with one of them reaping a return of 84.7% as of December 17th. So this guy knows exactly what he's doing here. And he is saying don't touch Evergrande distressed debt. It is toxic waste. It is garbage. Those gains were made largely on bottom fishing onshore bonds of distressed companies, including China Fortune Land Development and chip maker Tsinghua Unigroup Co., Zhang said. His firm had more than 568 million yuan, which is the equivalent of $89 million in assets under management as of last Tuesday. We tried once to gauge the recovery ratio of Evergrande onshore bonds, but we gave up buying them as it has excessive wealth management products and financing off its balance sheet, quote unquote. Once again, it's not what we know that is the risk in this disaster. It's what we don't know. The cockroaches involved in this disaster who we haven't heard from yet. Keyword yet. Zhang continues. Mutual fund houses and asset managers are dumping large amounts of onshore property developer bonds, which quickly slumped to record low levels. This will drive up costs of primary market issuance along with the pricing of loans and trust products, creating a vicious cycle that will further squeeze the cash flow of troubled developers, he said. Zhang's cautious view on Evergrande's contrast with more upbeat assessments from international distressed debt investors, including Marathon Asset Management. Watch out here. Perhaps Marathon Asset Management is one of those cockroaches we were just talking about. The developer was labeled a defaulter for the first time earlier this month after it missed making coupon payments on two bonds. The company, which disclosed more than $300 billion of total liabilities, make that $500 billion by the way, as of June has said it is quote-unquote actively engaging with offshore creditors on a restructuring plan. Good luck. And here's more trouble from China. We know that we have a massive trade imbalance. We import more than we export to China. This is not new. But now we're having problems with Chinese exporters for the first time in a long time. Before, it was the trade war. Now we have shortages and inflation and the supply chain woes, with goods not moving across the ocean. And now China has to support their exporters. Remember, China just injected $188 billion into the economy. On top of that, cutting rates. And now, measures to support exporters. Something is happening here. The dominoes are falling and China is scrambling. And of course, China did not live up to the so-called trade deal, which we know was a fugazi to begin with, because they've only fulfilled about 60% of the agreed goal here. We're missing 40%. But and this is important, they are hoarding commodities like crazy, be it iron, be it copper, be it grains, be it meats, be it softs, as if China is preparing for a disaster scenario here, a global economic crisis. And if the global economic crisis happens as we expect, of course, we will see a massive global famine, and China wants to avoid that dire scenario. You can do that if you have a healthy meat industry, aka the pork industry in China. To have a self-sufficient pork industry in China and avoid the famine, you need feed for these animals. That happens to be soybeans. China decided to plant corn instead of soybeans this year, and therefore they have to import all of these soybeans from other countries, including the United States. So the majority of buying the 60% of the gold from the trade deal, they're hoarding commodities. The country which consumes half of the world's pork will maintain a target to produce 95% of the protein at home through 2025. China wants to be self-sufficient in poultry and egg, 85% for beef and mutton, and 70% for dairy, the Agriculture Ministry said, adding that they form part of China's food security goals. Are you paying attention or not? The targets will likely bolster overseas purchases of soybeans and feed grains needed to fatten hogs, cattle, and poultry. China is already the top importer of soybeans and corn, and has purchased unprecedented amounts in the past 2 years to feed a hog herd recovering from the African swine fever. The buying binge sparkled a global price rally as investors were also worried about supply. The self-sufficiency goals, which were flagged since 2020 at least, come as the deadly African swine fever outbreak about 3 years ago destroyed roughly half of China's hog population and spurred a surge in meat imports and record pork prices. It also accelerated a push to modernize hog production and cut costs. Today, the nation's herd has recovered to a 6-year high and is 17% bigger than before the disease struck. Futures in the Dalian are down about 50% this year, underscoring the boom-bust cycle China's pig farming industry is notorious for. So you have Chinese stocks collapsing. You have the Chinese real estate market collapsing. You have a scramble to secure commodities. As the trade deals with the US and European Union fall apart, it looks and it sounds as a wounded empire on its way down, and it's swinging all over the place. We're not calling for the end of China, it's not going to collapse here, but we're calling that perhaps China is heading into a massive economic slowdown. And if China slows down, China is too big to fail. The slowdown in the Chinese economy will be contagious worldwide. When we talk about swinging and silencing every critic out there, look no further than JP Morgan CEO Jamie Dimon, who is a well-known pussy, of course, but this is weak even by his standards. He made a joke that JP Morgan will outlast the CCP. Next thing you know, he's apologizing not just once, but twice about a joke he made. And the Chinese are being extremely aggressive against any criticism, and they're punishing any foreign company that criticizes Chinese practices. Take, for example, Intel. The company came out criticizing the practices in the Xinjiang region and banning imports from that particular region. Immediately, they were forced to apologize to Chinese customer over the stance. And Intel is not the only one. Even other countries, smaller countries, are being punished here. China threatened to send Lithuania to the garbage bin of history after it stood up to Beijing by strengthening ties with Taiwan. When you have a wounded animal swinging all over the place, I know the analysts and the experts say that an invasion of Taiwan is not on the horizon at all, but we're eyeing two fronts here, with Russia eyeing Ukraine, and then we have China eyeing Taiwan. And Taiwan is the crown jewel for the economy, the global economy, that is. The reason is the consolidation of the chip industry within Taiwan. An invasion of Taiwan will slow down the entire global economy and add more pain to the supply chain woes. We already have a chip shortage. A disruption of chip manufacturing in Taiwan will add massive pain to the global economy, specifically to the U.S. economy. But here is the biggest problem that nobody's talking about, perhaps the biggest bomb to be dropped here. We've been in cycles of boom and bust, a period of a thriving Chinese economy, and other periods of slowing down in the Chinese economy. We've been through these cycles before. A slowdown in the Chinese economy, yes, it is bad for the worldwide economic growth picture, and it is bad for the stock market, of course. But what if I told you that perhaps this is not our main concern here? Perhaps there is another shoe to drop, and the clue was in Nike's earnings. Something strange is happening in China right now, and it spells upcoming trouble for American companies doing business in China. You see, Nike reported earnings last Monday, and there was a hidden bomb within that earnings report that nobody paid attention to, and nobody's talking about it in the media. Even market participants, the delusional, mad persons that they are right now, they put their blindfolds on and they decided to buy Nike stock anyways. The headline reads from Bloomberg: Nike gains as growth in U.S. helps overcome China collapse. Interesting, the wording here. Collapse. What are they talking about here? Revenue in North America rose 12%, helping offset a 20% drop in China, as overall sales surpassed analysts' expectations. The stock rose as much as 4.8% in aftermarket trading. And here is the earnings report from Nike. Notice the year-over-year change for the same quarter. In North America, the total sales number went higher by 12%. In Europe, Middle East, and Africa, it went higher by 9%. In China, Greater China, revenues were down across the board, and all in all, down 20% year over year. Now, you might say, yeah, the Chinese economy is slowing down, and that explains that. Wrong. Remember Alibaba's sales during Singles Day? Matter of fact, Singles Day sales surpassed all records, the highest of all time. Single Day sales in China make Black Friday sales in America look like a little baby. So we know that the Chinese consumer is not weak yet, keyword yet. So what's going on here? Something strange is happening in China. Nike earnings pass a test, but there is something going on in China, and it is not good. Despite Nike's confidence, inventories remain tight and are affecting manufacturing and the delivery of goods. And those problems have been obscured by weakness in China, where revenues tumbled by 21%, offsetting gains in Europe, Middle East, and Africa region, where revenues rose 6%. The brand's ability to recover in the world's second largest economy has become a focus among investors, which analysts say is a key to the company's future growth. The decline in China is certainly alarming, quote-unquote. BTIG analyst Camille Leon told Yahoo Finance this week. It was far steeper than what we had anticipated, a negative 24% decline on a constant currency basis. We were thinking down 13%. That is worse than its peers, such as Adidas and VF-owned Vans. The analyst added. This is important, by the way. Why Nike in particular getting hit versus Adidas and other manufacturers? There is something going on in China, Leon said. Through our work, we have found that there has been pretty good evidence of really hot releases and launch products that Nike sells out typically in minutes, sitting idle on shelves in China, quote unquote. For reasons both political and practical, Chinese consumers have spent less on foreign brands in recent years. They've started to buy more locally as competitors make higher quality products and sell them through marketing channels that attract younger buyers. Here's a tweet from Matt Powell. Prior to the pandemic, Western brands were getting nearly all their growth from China. Now, the Chinese brands are winning in China. Future growth for Western brands will be much more challenging. Are you listening, market participants, or not? Are you listening, Wall Street analysts, or not? Who continue to say that yes, the Fed is hawkish right now, the Fed is not accommodative, and the fiscal policy is not accommodative either after the fallout of Build Back Better. But rest assured, corporate earnings are still intact, and therefore you have to stay long the stock market. Tell me again how corporate earnings are still intact when the biggest growth market for American companies is slowing down because consumers over in China are being driven to local brands, be it because they like local brands or be it a patriotic sentiment from the Chinese consumer to forego purchasing from American brands. If that is the case, oh boy, the consumer brands, Apple, Starbucks, Tesla, Nike, Yum Brands, they will suffer pain like you have never seen before. And if these names fall apart because Chinese revenues are slowing down, do you really think that the stock market will hold when these gigantic stocks fall apart? And yes, consumer brands like Apple, Tesla, Nike, Starbucks, they don't have the highest exposure of revenues to China. These are the companies with the highest exposure of revenues to the Chinese market. They're mostly chip stocks, casino stocks, but here's the thing. Yes, companies like Qualcomm, for example, make a huge chunk of the revenues from the Chinese market, but for now, the Chinese chip industry is not developed enough to forego the dependency on American chip makers, the likes of Qualcomm. If the slowdown in revenues from Nike was due to the change in sentiment from the Chinese consumer to be anti-American brands and favor Chinese brands instead, then the majority of pain will happen in consumer brands, the likes of Nike, Starbucks, Yum Brands, Apple, Tesla, not the chip stocks. And of course, you have to be really concerned about Chinese companies listed in the American stock market. We know what happened with Didi, and this is just the start, by the way. If you have exposure to Chinese stocks, you have to be really careful. Here are the 10 US listed Chinese stocks with the greatest American ownership, and Alibaba is not one of them. And this is, of course, contrary to expectations. So, what are these names with the highest or greatest American ownership? The top 5 names on the list by US ownership include biotechnology companies BeGene and Zylab, KFC parent Yum China, and dating app operator Hello Group. The 5th name, Joy with a double Y, is a live streaming company formerly known as Double Y. The median share of U.S. ownership for the top 10 names is 43%, according to CNBC calculations of the Morgan Stanley data for stocks eligible for secondary listing in Hong Kong. The median for the top 50 names is 27%. That of Alibaba is far lower, 13.1%, while Chinese electric car startup NIO has slightly higher share at 20.4%, the report said. So here's the bottom line, folks. When it comes to the wall of worry and the concerns regarding China, we're not just talking about a slowing down in the Chinese economy or the Evergrande disaster. We're also talking about a Chinese consumer that is shifting from spending on American brands to Chinese locally made brands. The majority of growth in revenues for these giant American consumer brands, the likes of Apple, Starbucks, Tesla, etc., the majority of the growth is coming from the Chinese market. What happens when that growth slows down and the Chinese consumer starts to prefer other products? Well, you might say, who cares about the Chinese market? Look at what happened with Nike. Yes, revenues from China went down 20%, but they went higher by double digits in the US market, and therefore, who cares about China? Here's my response. The strength in the US market is due to the stimmies and the easy money policies. Those policies are coming to an end. The U.S. consumer already exhausted the stimmies, and now with the child tax credit payments are gone, no more stimmies, and we have data that U.S. consumers have already exhausted their savings from the pandemic, so all of these savings are now spent. They're gone. And we know from data that we covered in this program numerous times, the American consumer is now resorting to the last stage of spending. Stage number 1, stimmies. Stage number 2, savings. Stage number 3, racking up credit card debt. And credit card debt is surging higher. What happens after that? Where will the strength from the U.S. consumer come from if they have already exhausted their spending reserves? Add to that the shift in sentiment from the Chinese consumer, and anybody who says that corporate earnings growth is intact and that is the reason to stay long in the stock market in 2022 has absolutely no idea what they're talking about. But I know, rest assured, Papa Jerome got us. Continue to buy the dip because Papa Jerome got us. Forget about China, forget about Russia, forget about Build Back Better, we got Papa Jerome. Well, I got news for you. Papa Jerome is not on your side anymore. He's about to tighten, so it's time to wake the up. With that lovely message out of the way, let's move on to cover some charts and wrap it up. And we start with the 30 minutes chart for the SPY. What's going on here? The bulls are taking advantage of the seasonality and the low volume by pushing it to the limit as far as they can, which what they're supposed to do, by the way, taking advantage of the holiday trading week, the shortened trading week with the low volume to push the stock market higher. And of course, they have an ally in shorts because shorts also started to cover and book profits last week because it's a holiday week. You got to book profits before the holiday, before the seasonality takes place, and therefore we had the longs and the shorts working together hand in hand to push the market higher. And therefore you're seeing this massive, almost vertical pop higher. We are closer to all-time highs in the SPY. The problem is we're getting overbought not just in the 30, but in the hourly charts too. Soon enough, we're going to be overbought on the daily charts. The dailies did not move a lot due to low volume, but look at where the RSI is trading on the 30 minutes chart, for example. Every time we've traded at these levels before, we had a pullback, consolidation, or a gap down. This will happen sooner or later. Of course, the seasonality is still intact, and therefore the bulls, don't be surprised here if the bulls want to push it even more. They want to stretch it to the limit. Don't be surprised here. But sooner or later, the technicals would take place, and the higher the bulls push this market higher. On low volume, the bigger the flush down will be when volume comes back into the market. For now, we're looking at the support of 466.5. This will be support number 1, and then we'll take it from there. What about the daily chart? What's going on here? We have 4,657 as our bull to bear advantage line, and since we're trading above that line, the bulls have the advantage. Yes, the volume is too low, but look at where the momentum indicators are trading. They're all curling back higher. They're not solidly positive yet, but we're almost at all-time highs. We are still not overbought on the daily charts. Look at where the RSI is trading. So there is the contrast between the 30, the hourly, and the daily. What does that mean? Perhaps if we have a pullback, we could go down to revisit 4,657 and then bounce higher from that point on. We also have made the trading activities this week a higher low. So the bulls took the advantage and now turned the tables against the bears. The bears have the fundamental argument, not the technical one anymore, until the bears do some work here by flushing the market down to lose the support of 4,657, the bull to bear advantage line. What about the Qs, the 30 minutes chart? What's going on here? On Monday, I tweeted this. December 20th. The selling could dry out today, then we'll see the oversold short covering rally for the rest of the week. And this is exactly what happened. The Qs and the market as a whole bottomed on Monday, catching the support of 379 and did not look back since then. We've been almost in a vertical rally since then. And this is what I tweeted after that. This tweet was on Thursday, December 23rd. I said 397 on the Qs is where I will initiate a short trade. Meaning starting to buy some put options here, anticipating that overbought pullback. Here's what happened intraday. The chart faced a little bit of resistance at 397. And then, as I'm highlighting, this is a 5-minute chart, by the way, it caught support from 397. So it became evident to me that it's not 97. 397 is what the market is chasing right now. Of course, my expertise are limited to the algos. I know what the algos are looking for. The algos were looking for 397. Not the day traders, by the way. The day traders were looking for something higher. What was that higher goal, by the way? Let's go back to the 30 minutes chart. You see the breakdown candle that I'm highlighting right there? The high of that breakdown candle was 398.41. Guess what the high of the day was on Thursday's closing? Here it is, 398.41. A little spooky, but it's not a coincidence. The day traders had a goal. They pushed the chart all the way to the top goal, and then they took profits by the end of the day. We don't have another goal on top of that beside all-time highs. Now, if I'm right, then the overbought conditions will be resolved in 3 ways. Number 1, a pullback. Number 2, a gap down. These are the bearish scenarios, of course. And if we do pull back via gap down or a regular pullback, we have plenty of support on the downside, chiefly the support zone. But even before that, we have 392. That would be a good area for support before we bounce higher, or at least retest that support and see what goes from there. Then we have number 3. This is the bullish scenario in working the overbought conditions. You can do that via consolidation for a little while. That would be bullish because it's a process of gathering energy before producing another leg higher. Or you could gap higher again. The problem is, if you gap higher again and you're still overbought, as we are right now, not just on the 30 or the 45 chart, even the hourly charts are getting overbought now, then you risk the gap and crap phenomenon. What about the daily chart for the Qs, the continuous contract? What's going on here? We are done with the head and shoulder formation, in my opinion at least for now. And the reason is that produced not once, but twice, a 5% correction from the neckline. I think that's enough. I'm not saying that the market has bottomed for now, but I'm saying the head and shoulder formation has produced its due. So what are we looking for right now? We're looking at the bullish scenario. We have a sloping line of resistance. We hit it once, we hit it twice, and we hit it again on Thursday. We also have a double bottom. Now, this is a bullish formation. That doesn't mean that we should just blast through the line of resistance and not look back. The rational conclusion should be, now that we've reached the sloping line of resistance once again, we should pull back and the target will be 15,975 and then take it from there. If the market bounces higher again, then we know for sure that the market is making another higher low and that sloping line, descending line of resistance will be broken to the upside. Of course, the bears will counter and say, well, it doesn't count because the bulls made all of this progress on low volume. You got a point, but again, it counts. the charts already registered the gains. So you have to wait for a reversal, a clear reversal candle, before we have a confirmation that we will indeed pull back to 15,975. And you're not going to double down further on your shorts until that line is broken, and then we know, whoopsie, we just pushed higher due to low volume and the seasonality, but the bearishness and the selling will resume after that. Look at where the momentum indicators are trading right now. They are reversing the negative divergence, at least on the RSI. Soon enough, the MACD, the lagging indicator, will also curl up to the upside, to the positive side, creating green impressions on the histogram absent of a pullback on Monday. Now, here's my advice to the bears who want to buy puts on the Qs, playing the overbought conditions, playing the pullback. You're better off not making the mistake of buying weekly put options. A lot of you buy weekly put options out of the money, expecting the market will flush down or pop higher, aggressively so, in a short amount of time. That could happen, and you might score big, but that is all due to luck. And if you're going to continue to do that kind of trading, soon enough you're going to run out of luck and you will lose all of your money. It is not sexy, I know, but you're better off buying longer dated options, puts or calls, closer to the money, and using spreads. If you use these strategies, yes, it is not sexy, it's not going to make you big bucks right away, but in the longer run, your trades are going to be more profitable, opposite to the approach of buying out-of-the-money calls, out-of-the-money puts for the weekly expiration and hoping that you're going to hit. In the long run, I promise you, you will lose all of your money doing that kind of strategy. But the disciplined strategy of buying longer dated options, closer to the money, using spreads, you reduce your risk. In case you're wrong, no harm done. You can get out and restructure again, another trade. Moving on to the IWM, the Russell 2000 30 minutes chart, what's going on here? We had the massive pop, the rally higher on low volume throughout the holiday trading week, and we're now at 223 as resistance. The IWM hasn't broken above that level yet, and it is getting overbought on the RSI and the 30, the 45, the hourly. Sooner or later, we're going to have a pullback. Will it be from 223 as resistance? And if that is the case, then we're looking down at 218 for support. Or will it be slightly above 223, meaning the gap and crap scenario? We'll see, and we'll take it from there. But the risk versus reward says the majority of the gains in buying the dip in the small caps names, in the travel names, the cruises, the airlines, the majority of these gains already took place. The risk versus reward says watch out for a pullback in these names, specifically after the bad news that we got over the weekend. Moving on to the Dixie, the dollar index, what's going on here? It is flirting with breaking 96 as support. And the reason is we have the beaten down currencies, the likes of the Turkish lira, bouncing higher. That bounce is not going to last, by the way. What's going on in this country is nothing short of a disaster. Sooner or later, the entire country will fall down. But until then, if those currencies continue to surge higher, the dollar will end up breaking 96 as support. And in doing so, the algos will be triggered. What does that mean? Buying of commodities, pushing commodities higher, specifically precious metals. But beware of tricky Dixie. It plays dead and then it pops higher. We're not safe until 96 is broken for support. And I'm talking to the gold bugs, of course. Here's the chart of gold. The argument for gold is strengthening from a fundamentals perspective, from a momentum perspective, even from a chart perspective. The candlesticks are moving higher here. The problem is, if the dollar pulls another trick, bouncing from 96, then you'll see gold flushing down. And the line in the sand will be 1,763. You don't want to break that line. In the coming year, however, the argument for gold will get even stronger, specifically if we see the bond market reacting in a way opposite of expectations. What does that mean? Flattening the yield curve. If the Fed is about to be more aggressive, pushing rates higher, if the bond market says that will induce a recession, meaning a flattening of the yield curve, this will be extremely good for gold. And here is the chart for the 10-year yield. What's going on here? We made a higher low. The momentum indicators are getting stronger. The RSI has reversed the negative divergence. Not decisively so, but still the MACD indicator is also registering green impressions on the histogram, indicating that we have some momentum here in the 10-year yield. The problem is 1.5 remains resistance for now. And until the 10-year yield trades decisively above 1.5%, closing the week above 1.5%, we don't have a clear answer yet. You also have to keep in mind that the bulls were in charge last last week, and perhaps they will still be in charge in this upcoming week because it is a shortened trading week. The bulls want to push yields a little higher, not by much, but pushing it higher to reverse any signal from a flattening yield curve hinting at an upcoming recession, because the market does not like that. For now, the market is liking yields on the 10-year moving a little higher. Technically speaking, though, we don't have a conclusion yet because 1.5 remains resistance for now. What about the TLT? What's going on here? Perhaps we have some decisive action here. This is a weekly chart, by the way. It is more decisive than the chart of the 10-year, and the reason is the TLT closed the week below 149. Not by a lot, but it is perhaps a hint that the bond market will come to peace about the idea of the Fed raising interest rates. It is not decisive yet because we're not far below 149, but yet we have another weekly closing below 149. You could brush it off. It was a low volume week. It was a holiday trading week, yada, yada, yada. I get it. And therefore, I'm not making any conclusions one way or the other. What about the VIX? What's going on here? This was your leading indicator throughout the week. The spot-on indicator, the 4 hours chart of the VIX. It topped on Monday by closing the gap, and right there and then, that was the signal for me. By closing the gap and then flushing down, the VIX was saying the market will bottom today and will continue to move higher throughout the week. What happened after that? The VIX closed the gap below and it continued to move lower. Is this bullish or bearish? It is bullish for the market, bearish for the VIX. And then it continued to move down, breaking the support of 20. Again, is this bullish for the VIX or bearish? The answer is it is bearish and therefore bullish for the market, for the SPY. But here's the good news for bears. We continue to watch the MACD indicator, which comes hand in hand with the RSI, by the way. Both of them are curling higher in an attempt to find the bottom here. And if you start to see the MACD indicator curling higher, creating green impressions on the histogram once again, then you know the VIX has topped for now, and it is a time for a pullback. And if the VIX manages to recapture 20 as support by the end of the week, this will be music to the ears of bears. Moving on to the daily chart for Apple, what's going on here? It continues to move higher, on low volume of course, taking advantage of the shortened trading holiday week. No disappointment here, no surprises at all. If we keep the bull glasses on, what is the target here for Apple? It could move higher all the way to the sloping, descending line of resistance. And notice the correlation between the chart of Apple and the Qs. A lot of components within the Nasdaq have already collapsed. They've already bombed. We're seeing disasters in individual stocks within the stock market. Apple, the big caps, are the last man standing here. If Apple moves higher, it could go higher by about 1.7 to 2%. And then it will reach the sloping line of resistance. Here's the problem though. Let's take the bull glasses off and place our bear glasses instead. What do we see here from a bear's perspective? What if this is an ABC pattern, which will take us down not only to close the gap of 165.32, but perhaps going all the way down to retest the upper line of the channel, the trading channel that Apple has been in since last year. Next, we have Tesla, the souffle. What's going on here from a daily chart perspective? The bulls are in charge. Elon Musk, by saying that he's almost finished dumping, he ignited a reaction from shorts who are shorting Tesla to start to cover. On top of that, we're seeing a lot of call options buying. A lot of the 1100 calls were bought on Thursday with the same expiration date, by the way. Absolute insanity. But you add the shorts covering and the call options buyers and perhaps some retail mom and pops buying the dip since Elon is done dumping. This is what he says, of course, for now. And you have this massive rally higher. The momentum indicators are getting stronger. The volume is also picking up steam to the upside. All of these are good signs for the bulls here. We will look at 1,090.5 for resistance. If that doesn't work, then we have 1,174.5. That will be the next resistance, and after that, it will be the all-time highs. Of course, the problem here with Elon saying that he's almost done dumping, and when you listen to the podcast, you get the impression that he's already done dumping, and therefore the reaction was from shorts to start covering. The problem is, if he starts dumping again, meaning he's not done dumping, this will be a major problem. Yes, we know the SEC is in a coma, but this will be a major problem because you forced a reaction in the stock. You knew ahead of time by saying you almost or you're done dumping. You knew ahead of time the stock will move higher. Yet, in reality, you're not finished dumping, and you will resume dumping again. This will be a massive headache and a massive problem for the case of SEC versus Elon Musk. But until then, what about the weekly chart for the souffle? What do we see here? We have an obvious trend line with massive divergences, and every time we have a divergence, the chart moves down to revisit the trend line. We have negative divergence on the RSI, and we have almost a crossing in the MACD indicator. Yet the pop of last week managed to reverse some of the negative divergence in the RSI and delay the negative crossing in the MACD, at least for now. The bulls would argue, what if this is an ABC pattern? We made the A leg, then Elon started dumping, that was the B leg, and now the shorts are covering, the mom and pops are buying again, the call options mania perhaps will resume, and we will have the C leg higher, going all the way to all-time highs. The bears will counter by saying, look, every time we have a divergence from the trend line, we get a pullback of 30% or more. We have yet to have that this time around. It will be a better place to bounce from if the chart of Tesla goes down to revisit the trend line. We'll see who's going to win that debate, but I'm more interested in the SEC versus Elon case. Elon starts dumping again, aggressively so. Moving on to tulips. What's going on here? BTC. We have the saucer bottom. We know that for sure now. We have a confirmation. What if what we're seeing right now is merely a bull flag formation, indicating that Bitcoin will pop higher and perhaps it will regain the support zone between 53,200 and 55,300. As Mama Kathy would say, I like the setup for now. And you know what that means. Bitcoin will crash in the upcoming days. But anyhow, we're moving on to AMC, the last chart of the day. What's going on here? Still trading above 26, but here's the problem, folks. You got the resistance of 32, and you failed to recapture 32 as support, even though you had Spider-Man. Spider-Man was on your side. How many Spider-Man movies, by the way, you're gonna watch? They're just juicing you for more cash at this point. And I know, but bro, this was the first time when we found out that Spider-Man is gay and I want to watch the movie. Listen to me. Since I was a kid, I knew that Spider-Man was gay. I mean, the tight clothing, the spandex, the weird posing. Come on. Come on, man.
Come on, man.
I'm waiting for the transgender Spider-Man, with the main villains being Dave Chappelle and J.K. Rowling. But until then, let's talk charts. So long as the chart continues to close the week above 26, the hope is still alive. The problem is, and I know this is not a fundamental story, but the fundamentals are not adding up, with or without Spider-Man. Because even in countries or regions where the movie theater business is booming, for example, in Saudi Arabia, which happens to be the largest box office right now in the Middle East region. Even in that particular market, which is booming right now, AMC failed to capture the audience. And that tells me that CEO Adam Aron, his heart is not in this anymore. He just wants to retire. He's pumping, using Shiba, Doge, whatever buzzword of the week it is, to lure you in, and then he dumps, cashing in millions of dollars, and next thing you know, he retires. Goodbye. The Wall Street Journal says AMC was expected to dominate the Saudi cinema market when the kingdom's movie theaters reopened in 2018. Instead, local competitors have leapfrogged the American giant. The Emirates-based Vox recently opened its 15th multiplex in the kingdom and now has 154 screens, while Movie just opened its 18th site. Exhibition giant AMC is also active in the market with roughly 65 screens. CEO Adam Aron recently told the Wall Street Journal that the pandemic slowed the pace of its cinema openings, but that the company is perfectly happy and content, quote-unquote, with its expansion. Now, let me ask the apes a question. Are you perfectly happy and content with this performance for AMC in one of the hottest markets in the world right now? The movie theater business is dying in most countries, and of course adding to the misery, the pandemic. But even in the hottest markets out there, AMC continues to lag. But I know, bro, this is not a fundamental story. We're just playing the short squeeze. The holy short squeeze is gonna happen someday. Okay, I get it, and good luck. Lastly, moving on to the economic calendar for this week, what do we have? You gotta remember this, the seasonality is still intact. Yes, we have a trading week all the way till New Year's Eve. Friday will be open for trading. If I said otherwise earlier in the video, I am mistaken. The market will be open on Friday, New Year's Eve. But the seasonality is still intact. We're going to have lower volume than usual because a lot of traders already bailed out. Monday was the last day and they're going to come back in the new year. So what happens in a low volume trading week? The path of least resistance is higher. meaning this upcoming week favors the bulls. The problem is we're getting overbought in many charts. Sooner or later, the technicals will become important again, and sooner or later, the fundamentals will become front and center again. The concerns about China, Russia, the virus, DC, the fiscal policy, the monetary policy, the most important item, the hawkish policy by the Fed, inflation. All of these concerns will come front and center sooner or later. But until then, what do we have on the economic calendar this week? Nothing on Monday. Tuesday, December 28th, we have the S&P Case-Shiller Home Price Index. This will be important for the housing market. And then Wednesday, 29th, we have the pending home sales. We're going to talk about the housing market in a separate video. Then Thursday, December 30th, we have the initial jobless claims, the weekly jobless claims, and the Chicago PMI. And again, a reminder, Friday, December 31st, the market will be open, but the expectations will be for lower volume. And with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow.